Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is February 19th, 2010, and my guest is Barry Ritholtz, CEO and Director of Equity Research at Fusion IQ, an online quantitative research firm. He's the host of the investment website The Big Picture and author of Bailout Nation. Barry, welcome to EconTalk.
Thanks for having me.
The title of your book is Bailout Nation. Why did you call your book that, and how does it relate to the crisis?
Well, the title was actually coined by Bill Fleckenstein, who did the foreword to the book and had previously been the author of Greenspan's Bubbles. And the concept of it was just simply we had turned from at least the mythology of a nation that very much was independent-minded and, pick yourself up by your bootstraps, a land where anybody, if they are clever and work hard and apply themselves, can make something of themselves, and we went from that to, a group of coddled and overpaid bankers that are rescued from their own folly by the government. And it seemed to be the perfect fit for what was taking place.
We're not a nation that studies a lot of history, unfortunately, I believe. One of the things I liked a lot about the book is your tracing of this phenomenon. I think a lot of people think it started in March of 2008, maybe when we rescued Bear Stearns. But as you point out, it goes back a lot longer. In your narrative, where does it start?
The idea of bailouts, and I look at the universe of bailouts in two ways. It's one thing if you're an extreme skier and you go out into the backwoods and you find yourself in trouble. Hey, you took on that risk yourself. That's very different than people walking down the street when suddenly a building comes down or there's an earthquake or something else. I try to draw the distinction between people who are in trouble through no fault of their own and other people who elected to take a risk, to be aggressive, to speculate, and run into trouble. So I look at the Depression and its aftermath very differently than what came later. So the first real bailout where the government says, hey, you engaged in some really foolish behavior, and if we were truly a capitalist nation, you will suffer the consequences of your own folly, was Lockheed, was 1971. They knew their way around the government, around government defense contracting, and they had tried to get into building private sector planes, overextended themselves, built a couple of planes that weren't well regarded in the marketplace, big cost overruns, and found themselves, in a real precarious liquidity position, running out of money, and yet they have all these big government contracts that during a time of war, during the Vietnamese War. So instead of going through a normal reorganization process, which is what most companies do, they turned around and went to the government and said, hey, if you don't give us a loan, we're going to go bankrupt, and how's that going to help your war effort? And it was a very, very close debate. I believe the Lockheed debate might have been the one where the vice president had to break the tie, if memory serves. It was a very, very tough vote.
Because at the time, it was recognized that this was not business as usual.
Yeah, it was clearly not business as usual, and in fact, it was Senator William Proxmire, a fairly conservative senator at the time, who coined the phrase corporate welfare to describe the idea of it. Not only was it not business as usual, it was unconscionable to think that a company that in the marketplace ran into trouble because of its own management and decisions it's made and poor execution, to go to the government and say, hey, you got to give us a loan or we're in trouble, unimaginable, hard to imagine. And so
one of the justifications, of course, and the next one's going to be Chrysler. We'll talk about that next. But one of the justifications was, well, it's only a loan, right? They're not expect to get it back, and I think they did get it back.
Yes,
actually,
they did.
So it turned out, unfortunately, in my opinion, to look like it was not a big deal.
Well, when you think about that, it's okay. when you make law, when you make policy, when you govern a nation, the idea is to be broad and pass rules that affect everybody, not to carve out these specific exceptions for connected companies whose management is close to some elected official. So why are we giving it to Lockheed but not their competitors? Why are we giving a loan not to Grumman and not to Rockwell and not to Northrop and not to all of their competitors? You're giving a strategic advantage to one group of companies, employees, suppliers, and you're disadvantaging everybody else. And that's one of the fascinating things. Anytime we look at government actions, the government is essentially picking winners and losers. And it's great if you're in the winning pile. Hey, I got a big tax rebate. But if you're in the losing pile, or I got a mortgage modification to bring it up to speed. But on the other hand, if you're in the losing pile, wait, you mean I was practical and put 30% down and only bought as much house as I can afford? Those people are the losers in the math of that. Or if you're today, the best example is if you're a first-time home buyer and prices remain elevated because of all the government subsidies, well, you're the loser and the existing homeowners who overpaid are the winners in that scenario. With Lockheed, it's a perfect example. They won because they got this low-interest loan when they never would have gotten it from the private sector, and their competitors who were playing by the rules and doing well and executing, they didn't get that sort of credit line, and so you put them at a competitive disadvantage.
You also create the incentive for rent-seeking, a technical term, formal piece of jargon in economics, that rather than try to make better airplanes the next time, you might think, well, I'll just go to Washington.
That's the moral hazard argument, is every time you do one of these, you encourage more and more of them, because in the back of people's minds, hey, if things really get bad, I can always go to Uncle Sam.
So let's go to the next one, which was, I think, Chrysler. Is that correct?
Well, you have a couple of minor things in between. You have Continental Illinois in 74, and then you have...
actually, Continental Illinois is 84, and I don't consider that minor, so I want to come to that with a little more attention.
Okay.
But Chrysler...
And then you also had some of the railroad issues that took place in the 70s.
That's right.
But those were relatively minor. Chrysler was really a sea change.
It was also controversial.
You'll notice these things tend to happen during election years, not a coincidence, presidential election years. Lockheed was before the 72 election. Chrysler was before the 80 election. Not a coincidence. It was a swing state. Not a coincidence. It was a state that could have gone either way. But what made Chrysler so fascinating to me, just as someone who looks at history, is you end up with this icon of American industry that through a series of really, really bad decisions, some of which go back to the 50s.
Horrible cars.
Bad cars, bad design, bad union contracts that they had, all big three automakers, or big 2.5 as they were called by barons at the time, half referring to Chrysler, basically signed this contract in the 50s. It was after World War II. We're building out suburbia. Millions of GIs are returning home from war, and business is booming everywhere. And as opposed to risking a strike or falling behind production, GM, Ford, and Chrysler signed this very generous contract with the union that gave very strong health care and very strong pension benefits and pretty much guaranteed jobs, because they were just never perceiving what happened when the end of the baby boom bulge took place. I mean, they weren't even envisioning that. The demographic changes were still in the future. So they signed this contract to just let's crank out all these cars, and it took about 25 years before the effects of it were pretty widespread. Combine that with what took place with the oil issues in the 70s and the price of oil spiking, and you have a recipe for, as Warren Buffett said, the tide goes out and you could see who's not wearing a bathing suit. And it was pretty clear of the big three, Chrysler was the one that had the worst cars, the worst balance sheet, the worst corporate structure, and they were teetering on the verge of collapse.
And again, I think in that case, the government didn't make the loan, but they guaranteed the loan, which again got paid back.
Right.
Again, making people think it's not that big a deal. I, by the way, started teaching in 1980, and one of my students did a pencil drawing of Lee Iacocca for me with the legend "Our Hero," which was sarcastic. I didn't think very much of that attempt to save his company, nor did I like his attempts to keep out Japanese cars that the rest of us were interested in perhaps buying, and thought that was a good thing, and he did not. But I want to go to 84 because the Continental Illinois decision, for me, when I think my narrative starts there. I like that you brought in these other examples that I think set the stage for Continental Illinois.
Well, before we go to Continental Illinois, let's just talk about Chrysler for one more minute.
Sure.
And I always like to discuss the counterfactuals. Since we don't have access to a window to see into an alternative universe, you have to just hypothesize these things and say to yourself, what would the world have looked like? What would the American automobile industry look like today if instead of being rescued, Chrysler is forced to go through the difficult process of bankruptcy reorganization, perhaps even liquidation? What would have happened?
Great point.
And now, so everybody stops and says, well, you would have lost a couple of 100,000 jobs and you would have had this, but here's what we know happened. We know that from 1980 to 2-3 years ago, the UAW went from somewhere in the neighborhood of 1.5 million members to today they have under 300,000. This is with the Chrysler Rescue. That the big three auto share went from market share of automobiles in the U.S. went from greater than 75% to now under 50%, and that ultimately GM and Chrysler had to file bankruptcy in 2009. So that's what happened with the rescue,
which we're still paying, which we're going to pay for, I believe, and continue to pay for.
That's right. So that is what we ended up with after we had the rescue. Had we the argument, the counterfactual argument I make in the book is, if we would have said to Chrysler, well, you guys obviously are doing a lousy job, and while we're concerned about losing all these jobs, I think what we should do is, the most the government should do is to say to somebody, you're a significant player, we think you should reorg as opposed to liquidating, and if you cannot find any private sector financing, we'd be willing to, what I think we should have done with Warren Buffett and GE and Goldman, if you find somebody, we'll match the private sector debtor in possession financing, meaning you need a lot of money to put a big company like that through a reorg. So instead of us giving you $1 billion, find someone who will give you $500 million, and we'll match it, and therefore go do what you have to do. And had Chrysler gone through that process, we know a handful of things would have happened for a fact. For a fact, they would have gotten out of the onerous labor contract, pension obligations, healthcare obligations. That's number one. Number two, we can imagine that it really would have put the fear of God into the senior management of GM and Ford, although you certainly could make an argument that they would have just kind of snickered at Chrysler and said, see, we're doing something right, they went belly up. And perhaps it might have made the UAW a little more interested in negotiating a less of a Detroit, more of a Silicon Valley type of contract with much less guaranteed benefits and much more stock options so that the employees participate in the upside, whereas they're not guaranteed, and it really gives everybody incentive to do a really good job. None of that took place. We just kicked the can down the road 25 years, and you know how that ended.
All well said, and the counterfactual attempt to at least imagine what would have happened, I think, is extremely important. So let's turn to Continental Illinois, which is the first large financial institution rescue. And as you point out in the book, remarkably reminiscent of what we're in now, a highly leveraged bank making a lot of risky bets with other people's money.
That's exactly right. And how could that ever have ended badly? I mean, what a shocker that took place. So they were
they get. I want to make an observation here, which in my narrative I think is extremely important, and I think is often forgotten. They didn't get bailed out per se; it's their creditors that got bailed out. And repeatedly, what we do in the United States is bail out the creditors. Sometimes we let the firm fail, But we almost never, there's two exceptions we'll talk about, we almost never let the creditors go down. And of course, that encourages creditors to be less...
to be riskier and less prudent when making their loans.
Right, and that's extremely important. So they go down in 84, and then the next event I want to talk about is the 1998 long-term capital management, which you and others put a lot of weight on. I put some weight on. I'm not as convinced. I'd like to be, but I'm not as convinced. So give us a little of that background of what happened there. What their similar issue, highly leveraged firm, meaning very much using other people's money, borrowed money, rather than their own capital to make risky bets.
That's exactly right. And when you talk about leverage, we're talking about extremely leveraged. Plus, there was a little, for lack of a better phrase, there was a little air of mystery around long-term capital management. This was before quants were as well understood as they are today, prior to black box trading being as ubiquitous as it is today. A bunch of Nobel laureates with a very clever model managed to find these small anomalies, these small inefficiencies, and pretty much arbitrage them away.
Made a lot of money along the way.
Well, in the beginning, they made a ton of money because everybody extended them credit at very cheap terms because they wanted to do business with them. They were looking for a look at what they were doing, hoping to be able to imitate it and capture a little bit of that magic fairy dust gets sprinkled over them. And so you end up with long-term capital management based on actually a fairly valid idea, which was simply mean reversion. Look, we know there are these relationships with different asset classes, and so when this relationship gets too far out of whack, well, we'll just take the other side of the bet. The problem with that is if you're doing it with leverage, you have to hope that you're making that bet just as the stretched rubber band comes back to position and not before it keeps stretching. And that was the error that they had made, is they had deployed so much leverage and they had bought so much hard-to-trade, esoteric Russian bonds that were, just really small, tiny, odd little things. Look, you go out and buy a 30-year Treasury note or a 10-year Treasury from the U.S. Treasury. There are literally trillions of dollars traded on this, millions and millions. It's very liquid. You want to sell $1 billion, you can do it in a minute. If you're going to buy a small, thinly traded note that there's not a ready buyer or seller for, when you go to liquidate that position, you're not going to get anywhere near the current bid price because someone's bidding for 100 shares and you have 10 million to sell. It'll go from $100 to $20 in no time at all. So what made long-term capital management is it was a tremendous opportunity to send a warning to the marketplace that, hey, if you get into trouble because you're going to be speculative, because you're going to be highly leveraged, if you choose to, I call it the Beanie Baby hedge fund syndrome, if you choose to not buy stocks, bonds, options, and futures and commodities, things that are very liquid and easy to trade and easy to value, well, then we're not going to rescue you. Imagine a $1 billion hedge fund set up to only buy Star Wars collectibles and Beanie Babies. That's essentially what long-term capital management did with all this esoteric, thinly traded from all manners of the globe paper. And so why should the New York Fed have stepped in to save them? Had they not done that, it wouldn't have been fatal. It wouldn't have remotely been systemic risk. It would have punished, appropriately so, punished the companies that made bad bets. So it would have been Citigroup would have lost $3 billion, and Bank of America would have lost $2 billion, and $1 billion here, $1 billion there. But in the scheme of modern finance, relative to how much money these companies manage and trade and put at risk, it would have been a painful, knee skinning as opposed to a full-blown decapitation, which is what we saw this last go-round.
Well, two questions about long-term capital management. First, I want to talk about the firm that didn't get rescued. That those of us, I'm very much interested in this idea that moral hazard helped create the crisis. Past bailouts or the expectation of bailouts helped create the crisis. But those of us who believe that have to deal with two things one related to long-term capital management and one related to a firm we haven't mentioned, which is Drexel Burnham. So Drexel Burnham does not get rescued. They're a, quote, large financial firm, and they're allowed to go bankrupt, which they do peaceably, and the world doesn't end. As you said, it was a skin knee for some of their creditors and counterparties. It was unpleasant. Of course, it's been suspected, I don't know if it's true, that the head of Drexel Burnham, Joseph, was despised by the Secretary of the Treasury, Nicholas Brady, for what their previous interactions have been. That's the claim of James Stewart. I don't know if it's true, but that may have affected the politics of them being rescued. So they weren't rescued. So that was a signal, at least to some folks, that they might not get rescued. And then the long-term capital management, they weren't exactly rescued. The Fed orchestrated the bailout, not the bailout, the rescue. The Fed said, okay, all you guys who who lent money to long-term capital, rather than having them go bankrupt and you guys getting pennies on the dollar, why don't you guys figure out a way to keep them afloat for a while so there isn't this big collapse and catastrophic consequences? Perhaps there would have been, perhaps not. But the creditors themselves are the ones who played a role in the rescue, not the federal government. The federal government did orchestrate it, bring them to the table. It's true they made it clear that they weren't happy about long-term capital management going under and that they would work to make it happen. And, it's not really voluntary when they orchestrated it. They kind of forced these firms to do that. But the firms that were involved did pay a price. Do you think that's a correct counterpoint to your argument?
I think that's a fair assessment. I don't know if I would call it I don't think they paid much of a price. And the distinction between, let's say, a long-term capital management and Drexel, obviously you have an enormous criminal investigation into Drexel, the whole Michael Milken thing, the insider trading scandal. So Drexel was not perceived as a moral hazard or as a warning against speculation. It was perceived that, hey, if one of your senior guys gets caught doing something very illegal, your firm is at risk. That was back in the day when it was a partnership, not a publicly traded company. And the irony of Drexel, to me, is at the time they were the fifth largest investment bank, which is what Bear Stearns was.
Correct.
And the difference between the two, there were no allegations that Bear Stearns was doing anything illegal. There were allegations that they were doing things that were really stupid, but Correct. That's not the same. So I look at Drexel as sort of a special case, an independent case. You have a company that's caught in the middle of a huge scandal, and essentially a lot of their trading partners just said, gee, we don't need this. And you start having some senior producers leave. Remember, Milken was the big rainmaker there. So the name became tainted. I really look at that as a whole separate animal versus the Bear Stearns, Lehman Brothers, long-term capital management issue. But I think you're 100% right that these bailouts primarily have served to rescue the creditors of a lot of these companies. Look at the Bear Stearns rescue. Even though the transaction to J.P. Morgan, originally at $2 and ultimately at $10, down from almost $200.
Yeah, 172 was the
point. You ended up with the bondholders of Bear being made whole, getting
100%.
paid 100% on the dollar, just like the AIG counterparties, 100%. Lehman becomes a weird exception, and I think to some degree, there's a moral hazard argument with Lehman, but you have a very different situation with an insular chief executive who had the opportunity to rescue the firm, and he blew it. And one of the things people just don't know about Lehman Brothers, it's public, it's in the news, it was publicly out there. I put in the book, over the summer before they collapsed, when he was speaking to banks in Korea and trying to raise money, Warren Buffett made an offer. Warren Buffett said, I'll give you $3 billion, here are my terms, and the way I negotiated, you have two options. You can take it or leave it. And it turns out the terms he offered Dick Fold for Lehman Brothers were actually better than what he ended up doing with Goldman Sachs and GE down the road. He had even worse terms, but by then the crisis was more dangerous. And it's not just $2 billion from Warren. You get the Berkshire Hathaway, it's the corporate America good housekeeping seal of approval.
Right.
You take $2 billion from Buffett, you're rescued, you're saved, everybody else will be thrilled to lend you money, and now you avoid a crisis. Stop and think about the hubris of Dick Ritholtz to say, no, I don't want your money, this is a bad deal, we'll figure something out, thanks anyway. And 3 months later, they were gone. It's quite astonishing. And I have to think that at a certain point in the conversation between Ben Bernanke as chairman of the Fed and Hank Paulson as Treasury Secretary, they're scratching their head thinking about how they could get some money to Lehman Brothers, and they just look at each other and he said what to Buffett? He turned down how much money? How the hell can we give this guy a penny if he's turning billions of dollars away because it wasn't on terms he liked? I'm sorry, but if anybody needs to go down, it's this guy. And I know people have said there's bad blood between Paulson and
Fold,
but I can't help think that even if it wasn't Hank Paulson, it could have been Tim Geithner, it could have been anybody else in that room, people are scratching their heads and saying, you've been in a crisis, you just saw Bear Stearns go down, even though we guaranteed $29 billion for J.P. Morgan to buy them. How do you not take money from Warren Buffett? If I was a fly on the wall, I can't help but suspect that you would have heard someone say, geez, what was this guy thinking? How could we give him money? If we give him money after he turned down Warren Buffett, everybody will be lined up because it's clear that don't negotiate with the private sector. Uncle Sam is there to bail you out. That was the one approach to moral hazard I think they did right. What they then did wrong was say, all right, let's do a controlled bankruptcy. Let's do a controlled reorganization. Instead, they just kind of said, all right, well, you turn Warren down, now you're going to hit the pavement with zero net and everything will splat everywhere. And that's pretty much what ended up happening. Instead of doing a sort of, let's be honest, Bear Stearns was a controlled bankruptcy, and it was a sale of insolvent assets. Yeah. They could have done something similar with Lehman.
Well, they kind of tried. They tried to get Barclays to buy them, and they had a similar. Let's put this in. Let me give you a different theory and get your reaction.
Sure.
What the government did with Bear Stearns, for those out there who've forgotten, is they said, we're going to make it easy. Is that we don't want them to go bankrupt, which I think they should have done, but they said, we don't want them to go bankrupt, so to make them attractive to a suitor, we're going to guarantee, at first they said 32, it ended up being $29 billion worth of assets that perhaps aren't worth very much, perhaps are too hard to figure out what they're worth. We're going to make it easy for J.P. Morgan Chase to acquire them, and they did. With Lehman, they tried to do the same thing, but they wanted somebody to buy Lehman, but they wouldn't make that guarantee, right?
That's right.
And Barclays said, well, our regulator, the whatever it is, the Bank of England, isn't going to be happy about this, so we need the guarantee. And they said, nah, we don't think we're going to do it this time or whatever. So let me give a different interpretation. Yours is possible, of course. It could be they said, well, Fold's an idiot. Their public story is we had to send a message. We couldn't, we had to draw the line somewhere. Of course, then they proceeded to never draw the line anywhere and always pay 100 cents on the dollar, which is bizarre. But let's look at the political economy of it. You talk about it a little bit in the book on the Bear Stearns side. You point out that the biggest creditor of Bear Stearns was J.P. Morgan. They had a huge amount at stake if Bear went bankrupt. So they were very happy to acquire those assets and not have to deal with it. The question I have is, who are Lehman's creditors? In Lehman's bankruptcy, which I've seen, and I'm not very good at figuring it out, but best I can tell, most of their creditors were Asian banks who don't have a lot of political pull in Washington. It's not surprising that they couldn't go to Washington and say, hey, we don't want to lose our money. And then the other question I've seen nobody talk about, maybe you know, maybe it's not knowable. When Bear Stearns was rescued, they didn't go bankrupt formally. You said it was a controlled bankruptcy. So what does that mean for somebody who held credit default swaps on Bear Stearns, people who bought insurance for Bear Stearns' potential bankruptcy versus people who held Lehman credit default swaps who were now owed money because the government let them go bankrupt? There's a massive economic stake, financial stake that people had in both of those actions, and there were huge winners and losers, and I haven't seen anybody talk about who those winners and losers were, which I would think would be kind of important for figuring out why the government did what they did. You know anything about that?
Well, it's a fascinating point, and when you look at what took place when Bear Stearns was in the process of collapse, the thought process was that a lot of the people who had bought CDSs either betting on, it's not so much betting on the Bear Stearns bankruptcy, but betting on their credit worthiness, also had positions in options that bet on the stock price. So the scuttlebutt, and this is just Wall Street rumor, it was never verified, was, well, they didn't make as much money as they would have made had Bear Stearns bonds gone to zero, but they made enough money on the equity side that, let's not get too bent out of shape. I don't buy that argument. I think that the government steps in and they're picking, again, it's back to picking winners and losers, or making winners and losers. Whoever's on one side of that CDS trade that should have been paid off is now a loser instead of a winner. There's some argument to be made that when you have systemic risk, one of the risks involved in those sort of bets is the risk that the government won't allow these companies to go belly up. And after long-term capital management, hey, anyone who's making that bet should have been aware that the fact the Fed does come in and sometimes...
Good point.
So regardless of that, though, it's absolutely, imagine a close Super Bowl game and you have the Vegas book on guys betting on each side, and it's as if, with the clock winding down and both teams leaving the field, the government steps in and says, we decided to add 3 points and we change the outcome of the game.
We're going to make you kick the field goal that changes whether they covered or not. Yeah,
exactly. and so you literally have the decision-making process picking winners and losers, and I think people don't think about that enough. The general sense is what the government. I keep hearing about this in housing, which has been a pet bugaboo of mine for years. But just today, I think it was in either the Journal or the Times, something about another $1.5 billion is coming in to prop up housing. But when you by propping up housing, you are punishing renters who want to buy. You're punishing newlyweds who are saving to own. You're doing even 0% interest rates. You're punishing the elderly who are on a fixed income and hoping to generate some sort of revenue off of bonds, off of their holdings. And wherever you look, every time there's a decision, I'm not saying the government should do nothing, shouldn't be involved in any of this stuff, but we need to be more cognizant of you are picking winners and losers and very often rewarding the profligate and punishing the prudential. And I think that's a mistake that we make all the time.
Couldn't agree with you more. Let's. I want to shift gears a little bit and talk about another strong theme in the book, which is often forgotten. And we talk a lot on this program about the Federal Reserve and monetary policy. We've had a lot of guests recently on it. But you talk about something that we haven't talked about that I think is extremely important. You talk about going back as far as 1987 to Alan Greenspan's behavior in not bailing out the way that Bernanke did with or Paulson with a $700 billion check, or say taking over Fannie Mae and Freddie Mac's obligations, $1 trillion, which puts them on my balance sheet and yours instead of the Chinese or whoever lent them the money. But instead, bailing out implicitly in this weird way by trying to manipulate short-term interest rates the way the Fed does and prop up asset markets. So talk about you have a very nice narrative in there. I really haven't seen it all put together the way you did it, about what Alan Greenspan did and got away with, and I don't mean that in the criminal sense. I mean he didn't pay a price for it for a long, long time, and then it blew up in his face. So talk...
It's funny because you mentioned history earlier, and I love the Benjamin Disraeli quote. The one thing we learn from history is that we essentially learn nothing from history.
Yeah.
When I watched this whole thing unfold, both as a trader and a market watcher, and then you go back and you read the history and you find some details you didn't know. I didn't realize that back in the late 80s, early 90s, the Fed chief could cut rates between meetings on his own.
Well, we just had a guest on, Michael Belangi, who detailed that. He did it, I think, 6 times.
Right.
And he did it in clever and it wasn't secretive. It just got around the rules. It made him look more authoritative. It didn't require him to put through a rate change that was, say, controversial among the governors. He could.
Although I note in the book that maybe this was a little bit of hubris on his part, but it was getting good to him, and he actually did one of the rate cuts like a week or two before the next FOMC meeting. And that's at that next meeting, the FOMC took away the Fed chair's power to do that. That was the last time that happened. You haven't seen it since. Uh-huh. It's always been a decision. So when I went out and was doing the research, I'm like, gee, the Fed chief was able to do this, and he did it. So let's go back to 1987. You have a new Fed chief who's a little green and not familiar with. You assume that position.
Scary.
It's definitely a learning process, and I thought it was quite fascinating that you have the 87 crash, which in and of itself was sort of a unique event. Normally, when you have a market crash, it's normally because something else is going on. Stocks just don't drop 20-30% because traders, switch to decaf. It reflects something that's going on, and as we've seen, markets frequently get things wrong. They go too high, they go too low, but for the most part, for the middle part of the meat of a market before bubbles inflate and the crowd becomes, euphoric, markets do a fairly decent job getting a sense of price discovery. And so when you have the stock market collapse through a combination of, and we could spend months debating why it collapsed, but
there's been a lot of speculation, people trying to uncover maybe what might have caused it, but for whatever rate, it plunged rather badly.
The general sense is you have a newfangled product called portfolio insurance, which was a derivative-based product, and very creaky infrastructure. If you read, I think the book is Black Monday, which I reference in Bailout Nation, that author does a great job explaining how creaky the plumbing and infrastructure of the exchange itself is, and there was reasons why you couldn't get through your brokerage firm, and the infrastructure just wasn't there. And so that and some intemperate comments from the U.S. Treasury Secretary about the dollar, and you have a 23% one-day drop on top of the 15 or so percent we had dropped leading up to that point. But the fascinating takeaway that I think Greenspan learned from the 87 crash was that, hey, you could have a market crash and clean up afterward, and there's no real broad economic effects in the broader economy. And the strange thing is, if you take that one anecdote and say, well, let's look at history and see if this is a one-off or not, you discover it actually is the exception to the rule.
Right.
And in just about every other case, in fact, I want to say in every single other case I've come across where there have been a substantial market dislocation, I mean more than a 5 or 10% correction, I mean a real serious shellacking, and 23% in a day certainly counts, there's always been major repercussions. Your Great Depression followed the crash in 29, and look past 87. Look at Japan and look at the U.S. in 2000 and look what we just went through. Go through history, go through markets. You're hard-pressed to find, go as far back as the 1600s and the tulip bubble, you're very hard-pressed to find a boom and bust in a market that didn't have a major impact on the broad economy. So instead of realizing that 87 is an oddity, it's a one-off, it's the exception, Greenspan drew the conclusion that, hey, it's easy to clean up after a market crash.
So how did he clean up?
Well, he cleaned up with the strongest tool the Federal Reserve has, which is cutting rates. And so we cut rates fairly aggressively after the 87 crash. The odd thing is that what that ended up doing was causing a little boom in the real estate market, and then when things started to seem to be stable and rates went up, well, it's very simple math with the cost of houses. Cheap rates means your monthly costs are much lower. Rates go up, your monthly costs go up. prices of housing. This is what really was so infuriating, listening to people say, we've never had home prices drop in the history of that. Just not true. Obviously, the post-Depression era home prices really collapsed, but just look at, from 89 to 96, you saw a drop in home prices.
In major cities, for sure.
Right, that's right. And it was a relatively mild price. But, look, whenever someone says this doesn't happen, and I have to go back to 1740 to find an example, you can excuse them for not digging that deeply. But when it happened, a decade or so earlier, you know that these people were just repeating what they've heard and not actually looking at the data and drawing intelligent conclusions. They were just saying, home prices never go down. We know that's absurd on its face just from the 20th century, but obviously what's happened over the past 5 years, hopefully no one will mouth that false statement. But back to Greenspan and stock market, he started to recognize that he could more or less influence the outcome of the stock market by raising or lowering the price of interest rates.
Now, how did that mechanism work? What was going on? Why was he able to do that? Why was he able to, through lower interest rates, push up the stock market back from its depths after that collapse in '87?
Well, put this into the broader context of what came before. You had the huge spike of inflation during the 70s. You had Volcker in the early 80s taking rates very, very high. And even when the back of inflation was broken, rates had come down, but really were somewhat elevated compared to historical levels. In the mid-'80s, you had the economy recovering, you had the stock market doing well, but if memory serves, I'm not looking at the data now, Fed rates were around 8%, mortgages were in the 7, 8, 9% range, and so you still had a little bit of room to squeeze out some more performance by taking rates lower, bringing them back to or below historic levels. So every time we sort of ran into a little bit of a minor recession, and recessions aren't things to be feared. They're normal part of the economic cycle. You clear out dead wood, you clear out the malinvestment. There's a famous quote that during recessions and bear markets, money returns to its rightful owners, which I've always interpreted as meaning
careful people make money.
Yeah, exactly. And so we saw this again in 90 and 94 and 97 and 98. Anytime there was a threat to the stock market, you had the Asian crisis in 97, you had a recession in 90, you had a near recession in 94. Each time you would see some rate cuts. And it got to the point where traders on Wall Street pretty much figured out that they just had to sell stocks, and Greenspan would come in and say, well, if they're selling stocks, they obviously are seeing problems in the economy that we're not seeing. Let's head off a recession and cut rates. Instead of saying, by the way, there's a whole nother level of analysis and irony about this. As an acolyte of Ayn Rand and a, let the free market do what it's going to do, is actually pulling the levers constantly instead of that's between him and his shrink. I don't want to get into that. But to me, and maybe this is more of a power corrupts, and once you have that wave of applause of traders, I mean, he would walk into certain places and receive standing ovations, Greenspan, because, hey, he kept the rally going, he kept the market going. He was roundly criticized for not cutting rates sooner in 92 and helped the elder Bush lose, or at least that's been the accusation. So he learned how to play the markets like a fiddle with his hand on pretty much the biggest lever in the arsenal of government. And there's a tremendous level of irony there, but the bottom line is it became pretty clear to traders that Greenspan had their back, that you could buy pretty much anything, because as soon as the market ran into some trouble, the Fed would cut and cut aggressively, and that would juice everything, and we'd be off to the races again.
Well, when we had Michael Belangi on a few weeks ago, he's a former researcher in the St. Louis Fed, and we were talking about the challenge that the Fed has one lever, which is, it actually has a few more, but it's in one sense it has one lever, which is the discount rate. Another way to say that is it can have loose money or tight money. So it's got one lever, and it's trying to do at least four things that I know of. It's supposed to keep full employment. It's supposed to keep the economy growing. It's supposed to have stable prices. That's three. The fourth would be, bizarrely, it's involved in fighting poverty. It has all kinds of community banking activity and oversight of the Community Reinvestment Act, for example, because of that. So that's
when you look at those sort of things, those are, I always look at the CRA and things like that as if you actually read the legislation and read the rules that govern it, they're really rehabilitation rules to overcome the redlining problems that you had in the 50s and 60s. You don't have to open a bank in Harlem, but if you do, you have to at least offer similar terms on similar credit ratings to local businesses and residences. You can't just open a bank in Harlem, suck all the money out, and only lend it to co-op buyers in Tribeca. You have to say, if you have this income and this credit rating and this debt service in Tribeca, well, the same person will qualify in Harlem. You don't have to open a bank, but if you do, you have to treat all your clients well. I look at that as such a minor factor in what took place. It's really full employment or maintaining higher levels of employment and fighting inflation. And those two buckets can define 95% of what the Fed does.
Well, I'm going to put the CRA off to the side. Well, that's a topic for another time. But my point is that the CRA has an enormous amount of mission creep. I mean, the Fed has an enormous amount of mission creep, that it's got its fingers in lots of pies. It has lots of employment for economists, which gives economists, I think, a taint in their discussion of the Fed. But your point, which I think is spectacular, is in addition to stable prices, which to me should be their only mandate, they're supposed to keep the economy humming at a steady rate of growth. They're supposed to have this community fight poverty thing somehow in the background. And now we add, let's keep asset markets stable. Let's not let there be too much variance and swings in asset prices, and let's smooth that cycle along the way. And I think your point, which I think no one that I know talks about it, I'm really glad to hear it, the emotional impact on Greenspan of swimming in those circles of any chair, by the way, it's not Greenspan alone, any chair responding to the emotional and the adulation of the people he's, as you point out, he's making them winners. We're forgetting who's losing.
That's right.
Because he doesn't, their boos don't reach him at that restaurant in New York or where the trading floor he strides onto, and he's the best, he's the maestro.
That's right. What a tremendous name. We talk about mission creep. There was a speech I excerpted somewhere, and it said somewhere in the book, and he starts discussing things like psychology of traders, and all I can think of is, wait, so now you're the shrink-in-chief for traders.
He does it.
It's astonishing. I'm trying to remember which speech it was where he talked about, the phrase he used was confidence. We want to make sure that confidence is maintained in the financial markets. And I remember hearing that speech and thinking, why? Why do you want confidence?
Sometimes you want lack of confidence because you got bad times.
Yeah, sometimes you need to, there's good panic and bad panic. Sometimes when the building's on fire, you better run. Other times it's like if you bought something and you're losing a lot of money, well, that's a different response. And to say we're now concerned with the psychology of adrenal-crazed, traders who's got their fingers on a keyboard buying and selling millions of shares, that is not part of the Fed's job description. They can have confidence or not. They can make money or lose money, but that's not your job. And it's just amazing. He went that way.
Let's talk about 2001, because I think, in 2002 and 03 and 04, when he kept interest rates at historically low rates, around 1%, which many people now believe was a disastrous mistake. At the time, we I think gave him a lot of credit. We said, well, we faced the 9/11 attacks. The confidence was shattered. People were scared. It was really important to keep We were on the tech bubble had just popped, and we had to make sure we didn't fall into a Japan-like deflation and a horrible recession. So these interest rate drops were necessary because he was faced with this unprecedented terrorist attack, et cetera. But as you point out, that really wasn't the timing.
That's right. The September 11th happened, and at the time, my office was headquartered in Two World Trade, and I was working in the Long Island office. And so, this was not like an abstract event for me. I was watching this pretty closely. I was on the cell phone with my head trader as the buildings were going down. Everybody in our office had gotten out, but it was, a very real and visceral experience. And again, you live through it, and you have one experience, and you go back and look at the actual data and press releases and news, and I was struck by the fact that the Fed cut didn't take place that day, the next day, whenever. The Fed cut rates just as an hour before the markets reopened on whatever that week was. I believe it was September 17th was the day the market reopened after being closed for September 11th was a Tuesday. We closed Tuesday, Wednesday, Thursday, Friday, and then the next day when we opened, there it was. There was the cut, and you stop and think, gee, if you really, this was a unique period in American history, a terrorist attack on American soil with more than 3,000 fatalities, and a very visible signal, a very visible symbol of the United States. The Trade Center, stop and think about what the name meant. It was reflected globalization, reflected capitalism, reflected all these things. And instead of, doing it right away, he waited till the market was about to reopen. And that just said to me, gee, we are really all about the market now. The Fed is all about the market.
The stock market.
The stock market, and not about the economy, not about the country. The thought process is, hey, if we can get this sort of thing done now, with the market opening, and if we could make the market our focus, everything else will fall into place. And I think that's an enormous change in policy from what the Fed had always done.
I think it's an incredibly frightening change. And I'm thrilled that there are some people who are alarmed by it, at least a few of us, enough so that Ben Bernanke barely got reconfirmed, which I think I wish he hadn't been reconfirmed, but at least it's a start. So let's put this in a little bit of perspective and get your take on this. We've got what I consider two parallel tracks of bailout. One is literal bailout, where the Fed or the Treasury makes good on the promises of a financial institution that made bad bets, and its creditors should have lost at least some, if not all, their money. And not only do they not lose some of it, they don't lose any. So we did that many, many times in this last crisis, and we did it before that as well. At the same time, we have a Federal Reserve manipulating interest rates in the hopes of keeping financial markets from never going down too much. And people call that the Greenspan put. So we have these two tracks that both encourage recklessness, both encourage risk-taking, both remove the loss from the profit and loss equation to some extent, not entirely. As we said, Lehman went broke. Some people lost their money. There's no doubt that there were costs paid by people who made bad decisions, but a remarkable number of people who made bad decisions made an enormous amount of money, as you point out, and as I've written as well. Fold and Jimmy Kane of Bear Stearns, Fold of Lehman. True, they lost a lot of paper. They had a lot of paper losses. Each lost $1 billion. They each were left with about $500 million, money that they acquired by selling their own stock prudentially, not by playing recklessly with their own money. They only played recklessly with other people's money.
Not a bad payday for driving a 100-year-old company into zero, into the ground.
I agree. So we have those two things going on. What do you believe was the psychological impact on the players in the market? Do you think that they expected to be bailed out? Do you think they thought there was a chance they would be bailed out? Or do you think it was merely a subconscious possibility that may have affected them because it removed a fear that they might otherwise have had?
Well, which players are we talking about? The senior
That's
management?
the question, isn't it? That's the question. Because a lot of stupid people did make a lot of bad decisions and didn't get bailed out. And that happens all the time. People make dumb decisions. They think the music will never stop. They think housing prices can't go down. And they lose all their money. But the savvy people, the traders and the high-level executives are the ones who I think are the ones we ought to focus on. Because the claim is even they got just swept up in the exuberance. And I'm very skeptical of that. I'd like to hear your take.
That's a really interesting question. To me, the dividing line I draw, especially when you're talking about senior management, is the senior management of the publicly traded companies and the senior management of the big, non-public Wall Street partnerships.
Great point.
Going back and looking at history, everybody forgets throughout most of the 20th century, Wall Street were like law firms and accounting firms. They were partnerships. And at a certain point, the decision was made to allow them to go public. I'm not a scholar on that particular decision. I knew it took place around the same time we were deregulating competitive prices, and the Schwabs and the Muriel Sieberts were setting up their own firms to just provide basic execution issues. But when we look at the companies that got into trouble and the companies that didn't, it's not a coincidence that every single company that ran into trouble, there's a lot of OPM involved. There's a lot of other people's money and other people's capital at risk. You're a senior manager at Bayer or Lehman or Merrill or Morgan or Goldman or anywhere. The most that you could essentially lose is whatever you have in stock. That your risk is predefined. You have these pieces of paper, you have stocks and options, and hey, if you really mess up and the company goes out of business, that paper goes to zero. That is it. Now, there's a very different legal standard. By the way, as we've known, the shareholders took a loss and the taxpayers ultimately took a loss on those publicly traded
But
companies.
those executives who saw their stock wiped out, like Richard Fuld,
right,
they were selling all along the way to take pieces of their portfolio and their wealth out of their own company wisely, prudently, into other things besides the things their companies were investing in.
Right.
And they couldn't have captured those paper gains. When Bear Stearns' stock was 172 and Jimmy Cain was worth $1 billion, he couldn't have cashed that out.
Right.
That gave him the cover to play recklessly with other people's money. So the puzzle for me is, why did those other people lend him the money?
Step back a second and let's look at that instance, and then we'll compare it with the partnerships. One of the fascinating things that this is an argument in favor of clawing back stock option gains and going after the people like Fuld and Cain who cashed out is those stock prices were fraudulent. Those stock prices were based on an artificial inflation of earnings that was based on sheer recklessness and sheer leverage and speculation.
Or what you call, I like, mark to make believe instead of mark,
right.
mark to market. There's mark to market, mark to the model, and there's mark to make believe.
That's right. Listen, think of it in terms of a race course. Now, if you set the course record on the straightaway, you set the speed record, but you don't break in time and you're going too fast to slow down and make the turn, and you hit the wall, that shouldn't really count. That speed record doesn't count because anybody could just floor it and hit the wall at the end. And that's pretty much what the banking industry and the investment houses did, is they were flat out running throttle wide open, no concern about making a turn, no concern about braking. And so, how hard is it to sell stock at 100 and 150 and 175 if you don't care if you're showing profits that are driving prices, but the prices appear to be based on normal banking policies and normal investing strategies, and instead it's based on just, flat out, pedal to the metal, and let's hope we don't have to hit the brakes or turn. So that's number one. Number two, and to me, this is the key psychology. This is the key difference in when you want to, when people say, well, I lost all this money and I wasn't acting more aggressively than I would have. If you're in a publicly traded company, you essentially have a limited exposure to the amount of stock you own, or in employees' cases, stocks and options. when we look at partnerships, this is a very different legal standard. If a partnership that has a worth of $2 or $3 or $5 billion ends up doing what Lehman Brothers does and loses $50 billion, well, first, the assets of the partnership are exhausted by creditors. They take the building and whatever business is there and whatever art is on the walls they can sell. But once the partnership, which is typically a type of corporation, once that's exhausted, the fascinating thing about partnerships are then you get to go after each and every partner. So if Bear Stearns was a partnership, they would go after Ace Greenberg and Jimmy Kane, and they would take
that
their houses,
million.
their cars, their boats, their Rolex, their Monets, their whatever you could sell at auction, they get to go after. Now, stop and think about all the companies that are big partnerships. Lazard Frères, which actually went public, but it was late in the process. They went public too late to get into trouble. And the Brown Brothers, Harriman, and there's a few dozen of these giant
Hallberg, Kravitz, and
there's a ton of these, and none of them got anywhere near into the leverage, the speculation, the trouble that the big banks is. Now,
neither did the hedge funds. I don't
that's
think
right.
as much
Also,
either.
Partnerships with. Now, if you're an investor in a hedge fund, theoretically you
took
are
a
a
risk.
limited liability partner. But if you're the
it's not
GP,
the
if you're the hedge fund manager, in theory, if Stevie Cohen blows up, they take his mansion in Connecticut and his car collection and everything else until the debts are paid down. So when you look and say, how is it that the risk management in partnerships was so radically different than the risk management in publicly traded companies, it makes it hard to argue. And you can't really find an example. We know all of the non-bank lenders out in California that were fond of the exotic mortgages and the subprime lending. We know of 380 or so of those went belly up.
They all went bankrupt.
Right. These are small firms that existed primarily to securitize, to sell loans to the securitizers on Wall Street, and you're talking about 10 and 20 and 30-man shops staked with 40 million or 80 million, and for a while they made good money. But I'm referring to the 50 and 100-year-old multi-billion-dollar firms, be they partnership or publicly traded. How is it that the partnerships managed to avoid this mess, and so many of the publicly traded companies did not? And you cannot help but draw the conclusion that the management was willing to take big risks with shareholders' money, but
not with their own.
Typically, they wouldn't do that with themselves, and that's why I have a hard time, giving these guys a pass.
Yeah, well, you said you weren't a historian. I'm not a great historian of this, but a lot of people, everybody picks their own pet thing to point at for the cause of the crisis. One of the things people point at is this change in structure of the industry from very few partnerships in the investment bank world to these publicly traded investment banks like Bear Stearns. And I think they miss the point that that's not a random event. And if you look at the history, I think you'll find, and it has to be verified, but I'm pretty sure this is correct, they go public in the 80s.
Right.
They go public in the aftermath, could be a coincidence, but maybe not, of the Continental Illinois bailout, where all of a sudden, to me, the signal, what was important about the Continental Illinois bailout is it says to financial players, if you leverage, you might not pay a price for it. A better way to say it is if you want to borrow a lot of money, you might be able to get it because those folks may be willing to take a greater risk with their loans than they used to be because now they may get bailed out, the creditors. And as a result, you can build an investment bank around the model of 30 to 1, 25 to 1, sometimes more leverage, and you're going to make an enormous amount of money along the way, justify those salaries and stock options, and your worst case scenario for you is, your stock goes down, but you've squirreled away enough along the way that you're going to do great. And it might not blow up. It's not like a plan. So to me, the publicly traded company, which is allowed through leverage to get enormously larger, the only reason that works is because those creditors are willing to take that new risk. And I think we changed the risk environment that they played in and made partnerships less attractive. To me, the mystery is why anybody stayed as a partner. And most of them didn't. Most of them did go public for this reason.
Where you had a senior manager who, I'm trying to remember the firm that came from old European money, and it was a famous name, and they just didn't care about going public because they had such a nice business model, and it was very genteel, and I'm drawing a blank on the name, but it's a very British royalty-sounding name. And there's a handful of them. There's a few of them. Some of them were out of Switzerland, some of them were out of London, and they were very happy, like running a few $1 billion and doing an occasional deal or here or two, but they were much more interested in the social side of it, and didn't feel the need. And you can certainly understand why some people are this way. I have a net worth of $1 billion. How much more money do I need? Who wants the headache with going public? We don't want public shareholders. We're very happy to be a quiet little partnership. So you end up with a handful of those sort of people, but they're few and far between, and the vast bulk of the publicly traded companies were, they were very, very happy to go for the leverage. And again, it's not a coincidence that a lot of these guys started out as sort of hard-scrabble traders. Or bankers. You look at the guys at Bear Stearns and you look at the guys at Lehman Brothers. Both had a reputation for not being Ivy League firms. A lot of Brooklyn guys come up and suddenly they're competing in the big leagues. And you really end up with a little bit, and again, I don't want to get into the pop psychology of this, but you end up with a sort of hyper-competitive, hyper-aggressiveness that you don't see in the old world, old-moneyed firms from Europe. It was a very, very different attitude. And
I think that's true, but there's nothing wrong with that, except when they were playing with my money. I don't mind.
That becomes exactly it. It becomes a competition to see how much money you could generate. And by the way, from my experience watching this, it wasn't about I want more money. It was about who's winning.
It's prestige. It's glamour.
It was a competition, and money was just the score. It wasn't money for its own sake. It was like playing a game of pickup ball, and you didn't care what the final score was as long as you won. It wasn't for the cash. It was.
I think it all mattered. All mattered. Right. Well, we're almost we're out of time, but I want to close. First, let me say a few nice things about your book, and I want to ask you a closing question. What I really like about the book for listeners out there is the span of stuff you try to explain in a very accessible way. Among all the books I've read on the crisis, and I've read way too many, I'm sure you have too, or maybe you stopped reading. I've stopped.
I tried not to while I was writing this one for obvious reasons.
Yeah, no, I agree. That's a healthy thing. But you cover a lot of history. You cover a lot of pieces of the puzzle in a way that a non-technical reader can really get a lot out of it. So it's an unusually educational book on the crisis without being dull, and I salute you for that. My closing question is, what have you learned? Not what have we learned. I don't think we've learned enough as a nation and as a body politic yet. We're going to be learning these lessons for a long time, and we're going to misunderstand many things, of course, inevitably. But I'm curious, as a player in the world that I'm not in the investment world, what have you learned personally from living through this remarkable time?
Well, two things, and before I answer that, I have to thank you for the kind words about the book. That very much was my goal, was to not, if you're familiar with the famous poem of the six blind men describing the elephant, I didn't want to just describe one aspect of this. I tried to take the 40,000-foot view and describe the central banking approach and what was going on with Wall Street and what was going on with Washington, D.C., and what was going on in the investing community and the broader economy, and I hope I made some progress in accomplishing that. In terms of what I've learned over the past 2 years, there are two lessons that stick out, and I'm sort of surprised by them. First, this country has more or less become ungovernable. I'm astonished that we have not taken any steps. We've essentially taken no steps to fix what was broken. And there are clearly many, many errors that took place leading up to this. There was no single factor. I try to point to a lot of them, and obviously on that list, one of the chapters has about 30 people and things to blame, but it's the first half dozen or so that are really so problematic. There's been nothing done. A year ago, I said probably the best trade you can make was to get long, torches and pitchforks, because when the population figures out how badly they're being robbed, they're going to rise up and the joke is, someone asked me about that the other day, and I said, well, my miscalculation was, first, I didn't expect the sudden death of Michael Jackson. That obviously was more important than this. And then we had a particularly close, finale in American Idol, and it goes back to the Roman bread and circuses. So that's the first thing that I learned is that, as long as the population is fed, they kind of roll over and don't care. They're on to the next issue. I'm surprised that there's been all sorts of sort of diffuse outrage.
Yeah, there's quite a bit actually. I'm a little more heartened than you are, but
I see the anger, but it's just more general and not how could you have done this, and this, and so that surprised me.
That's the half-empty view. The half-full view is when you almost don't confirm Times Man of the Year as the next as the continuing Fed chairman. I think there's some value. There's some optimism, source for optimism.
Yeah. The second thing, and this is stunning to me, is how human nature just is never changing. And so we come through the crisis. I don't want to say unscathed, but buildings are still standing, and people are still. You got to feed your kids and send them to school and make sure. The economy marches on. And speaking to investors over the past, 2 or 3 years as we've gone through this, if you were paying attention and you avoided the bloodshed in the market, great. If you got either lucky or whatever and managed to jump back in March when things were at their lows, that's terrific. Here it is. This is barely a year in the rearview mirror, and people continue to ask, so where's the next great money-making opportunity? Where's the next great? And there's
let him get by 10% again.
Right. There's no circumspection whatsoever. There's no, maybe we need to stop and step back a little bit and think business as usual isn't going to be what's going on. And yet I see none of that. I see basically a handful of people rotated out of stocks and into real estate and got caught in that boom and bust. And then they rotated into commodities, and then the start of the recession, they got hurt in that. And now what's the next bubble for us to invest in? And the corollary to this is The Onion is supposed to be a parody, a satirical newspaper, but it isn't. The headlines on The Onion just are so true. There was one not too long ago, America demands another bubble to invest in. And to me, that's one of the more surprising things. It wasn't, this bubble process is dangerous and we need to be a little more cautious. Instead, it's like, I hope I've learned to jump out before the next bubble pops, and please give me another one so I can make money on the upside. So if I had to give you two things, it would be how generally ungovernable the country seems to be becoming, and secondly, how human nature just never changes.
My guest today has been Barry Ritholtz. Barry, thanks for being part of EconTalk.
My pleasure. Thanks for having me.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.